us now from Cape Town is RCM Analyst Razeen Dinath. Razeen, appreciate your time this evening. We're focusing on the opportunities and challenges of investing in cyclical stocks this evening. And of course, cyclical stocks are those where earnings are driven primarily by macroeconomic factors. So when we've got a bull environment on the macroeconomic front, then you would expect earnings to rally and vice versa. Let's first focus on the opportunities that you see in cyclicals at the moment.
Hi, Bronwyn. In cyclical companies, you've got to be careful about forecasting earnings at the high point in the cycle, because you tend to be over bullish and think that those earnings are sustainable. But what in fact happens is that those earnings are mean reverting, and as the cycle turns and the overcapacity in the industry causes prices, the competitors to compete on pricing, you find that returns decline, and these businesses are normally highly leveraged, so you tend to get quite a lot of bankruptcies and problems, and they come to the shareholders to look for capital. So it's a very difficult industry. You've gone straight through to the challenges, so we'll bear with you on that front, but we've got to come back to the opportunities. What are the biggest mistakes that investors make when it comes to investing in cyclicals? Well, the biggest mistake is really being over bullish or over bearish. So at the top of the cycle, you think that this company's earnings are sustainable, and you basically forecast that earnings into the future and are willing to pay quite a high price for it. But it's a cyclical company, there's no barriers to entry. Basically what happens is other competitors enter the industry, they compete away the profits, and the cycle turns, and these companies tend to get into trouble, and then they're at the bottom of the cycle, earnings are negative, they might be making losses, there might be bankruptcies, and then people are very pessimistic about these companies. So what you would tend to focus on is don't be too bullish at the top of the cycle, and don't be too bearish at the bottom of the cycle. What we tend to do at RCM is look through the cycle at what is the normal level of earnings for a business, and then decide what would a businessman be prepared to pay for those normal level of earnings.
Razeen, David wants to jump in here. I'm going to bring it back to Joe.
Razeen, what I wanted to ask is which particular stocks would you be bearish of at the moment, and which would you be bullish of? In other words, where do you feel that they're below normalized earnings, and where are they above normalized earnings?
Well, if you look at some of the companies that are, well, one of the companies that is really well above normalized earnings is Kumba Iron Ore. This company has really benefited from the run in the Rand iron ore price, and it's done fantastically well. I mean, the profitability is seriously high, but what you find is that should the Rand iron ore price decline, and the supply that's coming on stream from Australia and the other big miners are planning to increase supply substantially, what could happen is earnings come under pressure, and suddenly what looks like a 10 PE cheap company is actually a 40 PE business.
David, you like Kumba Iron Ore?
I like Kumba because
are you holding it?
Yeah, because I get a 10% dividend yield, because what they make margins of about 50-60%, and a very low cost producer that pays out almost all of its profits in dividends to you. So I find it's even at these prices, it's given me a very attractive yield. And
you're not letting it go easily?
Not for the foreseeable future. I don't see pressure on the price yet. But I can be a lot more flexible than Razeen can. Now,
Razeen, I'm assuming that a stock that is trading well below normalized earnings would be Grindrod.
Grindrod itself is not is under a lot of pressure, and it's recently come out with a trading update which says that its earnings is going to be 35 to 45% lower. We've looked at it quite carefully, and we think it's trading around about fair value. It's not quite cheap enough for us to go and put clients' money to work yet.
So it's not, I'm actually wrong, it's not well below normalized earnings is what you're saying?
No, the earnings are under pressure, and it's coming down, but it's actually trading around about normalized earnings because it's trading at about fair value.
Would you look at the construction sector at the moment?
We've been looking at the construction sector, David, and it's also a highly cyclical industry. So what we've also found is that even though the prices have come down and earnings have collapsed, I mean for Murray and Roberts they're making losses at this point in time, but we're not at a big enough margin of safety for us to put our clients' money to work yet.
Okay, so now let's find a stock in your book that is trading well below normalized earnings, that is worth buying into at these levels, because we haven't touched on that yet.
Well, I caught a bit of the earlier program and you were talking about Anglo American Platinum, and that's actually a company that we have been buying and we think is quite attractive. And if you look at the platinum price, I mean it's actually trading at a big discount to the gold price, which is something that hasn't happened in a long period of time. The platinum company's returns on investment has been very good over their history, and the two largest platinum companies, Impala and Anglo American, control about 70% of the supply of platinum. So we think that it's good quality businesses and it's very cheap in relation to where normal earnings should be.
And you're not concerned about the trading update that we saw out of Anglo Platinum today, alluding to much lower earnings going forward?
Sorry, I didn't get the whole question.
The trading update that we saw out of Anglo Platinum today, you're not concerned about that?
No, we don't tend to focus too much on the short-term results. The short-term results can be very volatile. What we try to focus on is, again, looking through the cycle, what is the long-term sustainable earnings power of the business and what are the normal sustainable returns the business should generate, and then we figure out what we'd be prepared to pay for that. And if the share price is below that fair value, we're quite happy to invest for our clients.
Razeen, most value investors stay away from companies which require a lot of capital investment, like miners. And certainly something like the platinum miners continue to absorb or to eat capital. And also they're under a lot of pressure because of increasing costs. How do you overcome that and how do you justify that?
Well, we've looked at the long-term history of the platinum miners and they've actually not been that bad in terms of the free cash flow that they've generated and the actual dividends they've paid out to shareholders. In the 2004 to 2006 period, they were actually generating tremendous amounts of free cash flow and the dividend payments were substantial. They did then tend to over-leverage themselves and they got in trouble in 2008. But over the longer term, these companies actually deliver good free cash flow to shareholders.